Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us if the Fed and the Bank of Canada have more rate cuts coming up. He comments on the recent bounce in cannabis stocks and whether Bitcoin has bottomed out. President of InsideTrackTrading.com, Eric Hadik, is here to share his wisdom on the cycles concerning Bitcoin, gold, silver, platinum, palladium, crude, natural gas, interest rates, lithium, and agricultural commodities like coffee. Author of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, joins us from Edmonton to talk about the state of Canadian real estate. Toronto is in the grip of a major downturn, Vancouver less so. On the other hand, Calgary and Edmonton seem just fine when it comes to real estate, but the people buying homes there have a major problem. Hilliard, a longtime Tesla owner, also takes a look at what's happening with the electric vehicle market. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Good to be back, Jim. Here we are. The Fed gets around to their second rate cut in the last couple of months, and a quarter point, which was pretty much in the cards. However, if we take a look at where T-bill rates are at this point, the probability of another rate cut in the near future doesn't appear to be there. So, look at this as being probably, the last drop that we have for many months. On the Canadian side, the Bank of Canada decided that they were going to keep rates unchanged. So, you got equal what you would expect in the way of reactions here. U.S. dollar has been giving up ground relative to other currencies, especially against Canada and, against Mexico and Australia as well. So it's an interesting type of week.
Now, there are hints once again from the White House that President Trump might change the regulations concerning cannabis, putting it in the same category as over-the-counter pain pills. What's that doing to the cannabis market?
Well, you've got the two big ones, Tilray and Canopy, both having a pretty exciting week this week. You got from $6.50, or call it $7, round numbers, up to $12 on Tilray. That's pretty exciting, but still a long way from numbers that we've seen back in the heyday in 2019, or even in the interim highs that we saw in 2021. So, you want to buy these things when they have action on the upside like they did back in those days. But this move off the bottom is probably going to find itself priced in very, very quickly. And, don't look for too much more on the upside at this point.
How are the stock markets doing overall?
Well, you've got this rotation happening out there. If we take a look at the Microsofts and the NVIDIAs, they peaked out the better part of a month to 2 months ago and have been eroding away. If we look at the small caps like the Russell 2000, the IWM index, or the transport, they are just barreling along away on the upside with the really good upside action here. And that's part of the rotation that we thought we'd be looking at. This is, once again, very much like the end of the dot-com era in 2000, as we saw the first breaks into March, April back in 2000. Then you went into a consolidation phase for the next 4 to 6 months. And it could be that we're looking at that right now as far as the S&P is concerned, and maybe more in terms of weakness as far as the NASDAQ is concerned, the QQQs. So, it would be appropriate to be moving into the new sectors that are showing the strength rather than the ones that are giving up ground.
What's going on with gold and silver?
Gold finally came to life, managed to pump through first resistance levels here. We've been having difficulty getting through the 4250 level, but managed to punch through that at the end of the week. And it's probably just stair-stepping its way up now, and we're just going to be looking for some pretty good price action on the upside. But, the big move is over in silver. That's trading, got up to $64 this week. Big move. Look at us here at the end of October. We were trading as low as 45. So it's been a pretty exciting move there. And in the bull markets, you tend to see silver being the one with the exponential moves. It tends to top out with some good overbought signals, and we don't have any of that as of yet, even though we might be looking at short-term reversal here on Friday from the high. I don't think that we've seen the absolute high levels. We've got some channels that we look at that project back, coming back from 2002, so there's long-term channels. And we're looking at 75 or 125 as the two channel lines to keep in mind. And from a historical perspective, the 5-year cycle is scheduled to top out ideally in the first or second quarter of next year. So, you've got to give silver the chance to run. We got some great buy signals back in May when the relative strength index broke out, and it's been a nice run, small correction back in October, but this thing clearly, until it becomes excessive on the upside, it's got a fair amount of price appreciation ahead of it.
What's going on with Bitcoin?
Bitcoin, we got down to that extreme exhaustion level at the bottom end of the move. We were looking for it to rally back and kiss the 50-day Bollinger Band, and that occurred at 94,500 this week. And it would appear that it's ready to now go back down and retest the lows. We're at 90,400 as of Friday, and it's I wouldn't be at all surprised that not only do we maybe retest 85,000, but possibly take out the lows. That 94.5 should be looked at as the significant resistance as we move through the next couple of weeks.
What's going on with crude?
We're just grinding our way to the downside. We had been thinking that this would have a downside bias, and the rally peaked out this week at 60, and we're back down at 57 and change. So, there's nothing to say that it's going to hold here. Seasonality would suggest that we could get a poor December, January before we see a reversal. So ideally, we see this thing have an acceleration to the downside before it puts in an important bottom.
What's going on with the U.S. and Canadian dollars?
U.S. dollar, I was looking for it to hold, but didn't do that. We have been looking for the lows that we put in a week ago. Good oversold levels there to hold in place. That would have been around 99 on the index. We're currently at 98.25, so it's starting to slowly erode through the support. And, it's this point, the trend looks as though it's probably reasserted itself to the downside. And on the Canadian dollar, that one started to do well about 2 weeks ago relative to the commodity index and the price of crude oil, and has since continued to move to the upside. We've gone from 71 up to 72.5, so it's a pretty good move for the currency. There's no sign of divergence here, so as long as this moves up, as I say, relative to crude and the CRB, give it the ability to tack on, more to the upside. I don't want to put a price level in mind on this one. Just let it run until it's proved otherwise.
Ross, thank you so much for chatting with us and for being on This Week in Money.
It was a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Oh, well, thanks for having me back, Jim.
Eric, before we get rolling, can you tell us a bit about Inside Track, spelled with 2 I's, and how our listeners can subscribe?
Inside Track is a financial advisory service that focuses on technical and cyclical analysis of the markets and supplies different publications on a subscription basis. Listeners can find out a lot more information, see samples, and also our subscription options at InsideTrackTrading.com. That's inside with the extra I in the middle, so it's INSIIDE, tracktrading.com.
This week, the Fed lowered its trend-setting rate by a 1/4 point. Is this keeping in line with the interest rate cycle?
Yeah, it certainly is. My work still continues to look at a couple of significant peaks in the bond market that I expect first in January of next year and then in April of next year. And so since interest rates are inverse to that, that would show that you'd still see interest rates trending lower into the first part of next year. But I think it's once we get to the middle of next year when things might get a little bit more surprising.
The Dow hit new all-time highs, pulled back into mid-November, and has since been moving higher. What do your cycles see ahead for the Dow?
Well, I'm really viewing it as much from the overall market, although you do get, at every turning point, you get a series of highs or lows and divergence unfolding during successive highs, successive lows, and that's often a good indication when a market is completing a trend. But from the overall perspective, my work has continued to say that once we fulfilled those early April cycle lows, a 1 to 2 year cycle low there, that the outlook, both from a price perspective and a timing perspective, was for stocks to move steadily higher into the end of 2025 and possibly stretching into the first few weeks of 2026. But it's at that point when I think that we could see a more significant top take hold. A lot of the stock indexes have been following this very consistent, it's approximately a 13-month cycle. It's about 56, 57 weeks. And in line with the cycle progression indicator rules that I lay out in my work, They have gone through the transition. First, you saw very significant lows in September of 2022, then a subsequent low in October of 2023, and then you saw the transition or inversion point where that cycle consumes an entire move up between late October and late October of 2023 and late November of 2024. And that told me that once we saw the 20 to 30% correction that I had projected for earlier this year, that then we would move up into late December of 2025, which was the next phase of that 56 to 57-week cycle. And there have been a lot of corroborating indicators and cycles coming into play that are telling me we're getting near a significant top, and we could see another serious correction in the first half of next year. But there's a couple of, like I said, key indicators that are showing me we've got a little more upside in some of these indexes, and I'll be watching those and some related indicators to tell me when I think that both a top is intact and when an initial reversal signal and sell signal has been triggered. So whereas we are certainly continuing this uptrend since early April, we're now getting into what I think are the final stages of it in all the indexes.
Since mid-November, the Dow Jones transports have been moving significantly higher. Is this a bullish indicator for stock markets and the U.S. economy?
I think it's pretty much what I just described, that you had the transports trading sideways for many months there, and there was a level that I kept describing in my work that they needed to close below on a weekly basis if they were going to elevate or magnify that correction that you had seen between July and October. And they got within about 10 points of triggering that signal, but could not do it. And that type of failure, in this case it's a failure of a possible sell signal, ushers in the way and the time for a new rally, which is what you are seeing in the transports. They've got an even stronger convergence of intermediate and 6 to 12 month, 3 to 6 month cycles that are all coming into play in late December and early January. And really what you have the transports doing is finally getting back up towards their late November 2024 highs, which were also very close to their record highs of 2021. So you're coming into some very critical resistance levels in the transports. So I don't know if it has a lot of future projective powers, but I think it is fulfilling some of these 1 to 2 month, 2 to 3 month indicators and starting to near some extremes on the upside.
How are the cycles looking for the U.S. dollar?
The dollar continues to be in a slow, steady downtrend that I think on a multi-year basis is still going to see lower lows out over the next year or two. But we've really been in this consolidation since the July and September lows in the dollar index, and that consolidation is likely to continue. I'm looking at some cycle progressions that come together in the middle part of January, where if the dollar were to see another bounce, that would be a pretty significant time frame for for a new downturn. But right now, as far as the dollar index, it's really just trading sideways. Of course, if you dig down a little deeper and forget about the dollar index, which is just a comparison of all of your fiat debt-based currencies, and look at how many other contrary or alternative currency vehicles have surged to all-time highs in just the last couple months, whether that be your Bitcoin, your gold and silver, and other factors too. All of them show that by comparison, the dollar continues to weaken, and there's more of an underlying concern there than what you see in just the dollar index.
The Canadian dollar was showing strength this week. It looks like the Canuck buck might have put in a double bottom in November. Where's the loonie, as we call it in Canada? Where is it in its cycle?
Well, the Canadian dollar has been trending slightly higher since its third test of that major support. What is it, like the 68 level, I believe? Yeah, where it bottomed out in 2016 and 2020, and then again in 2025, when it rallied into mid-year and got up around that 74 level. The loon was setting what was likely a 3 to 6 month peak, and at that point, the retracement that it subsequently undergoes, there's two indicators that I watch to see if that is just a correction or if it's the start of something more negative. And it's a little bit like what I was describing in the Dow Transports, that there's this indicator. In this case, I was watching it on a monthly basis in the Canadian dollar, that it needed to give a monthly close below 71 to really turn negative. And if it didn't, that would show me that the correction was nearing fruition, and that at the very least, the Canadian dollar was ready to undergo a second similar rally, what would be kind of a C wave of an ABC upside move. And so that's where I think we're at in the Canadian dollar, that it held that support. It prevented any larger magnitude trends from turning back down. They're all positive indications that tell me we could see another 3 to 6 month rally in the loon, and that it could get, if it's able to close the year stronger, I would see it possibly getting up around the 76, 77 level sometime next year. So it has a fairly constructive technical and wave structure to it, and there's a couple levels of confirmation, upside confirmation I need to see.
Bitcoin bottomed mid-November close to $80,000 US. Since then, Bitcoin's been moving higher. What are you seeing in the Bitcoin cycle?
It's really the same thing I've been talking about for over a year, that some very more significant cycles. Now, obviously, in Bitcoin, that's not going to be as long-term as a lot of your other markets because of its limited history. But I explained how I thought the fourth quarter of 2025 would be when you would see a significant downturn in Bitcoin and Ether. Many of the cryptos had peaked along with what were penultimate cycle highs in July of 2025, and they were already starting to lead the way lower and show that there was some concerns there, and a lot of your crypto stocks also peaked during those July 2025 cycle highs. Bitcoin was able to spike a little higher into October and reach that major upside target that I was talking about all year, between 125 and 127,000. And as soon as we saw that hit, In all of my publications, I was explaining how the first thing we should see is a drop down to 80,000. And from a timing perspective, the first thing we should see is a drop down into the second half of November. And Bitcoin was very obliging with that and fulfilled both of those with some really uncanny precision, dropping into the week of November 17th to the 21st and attacking 80,000. That was my initial primary downside target. And as we hit that, and I explained why that should set probably a 1 to 2 month low, and that we should see a rally into the first half of December and up to a couple of key resistance levels that we still haven't quite made it to, but I think that those levels could end up setting the rebound peak for Bitcoin. And I've even started to hone those levels. I'm going to be discussing them in some impending publications this weekend. And that, if Bitcoin fulfills that, and if its timing and price for a rebound peak are anywhere near as precise as its fulfillment of the downside projections, then I would see the time when you could see another decent sell-off in Bitcoin and a lot of your cryptos.
Gold trading close to all-time highs. Are new all-time highs likely ahead in the gold cycle?
I definitely think on a 6 to 12 month basis, yes. Right now, I see gold in kind of a potentially a B-wave rally that ever since we set the late October peak, which fulfilled some 3 to 6 month and 6 to 12 month cycle highs, I've been saying that gold is likely to be in a consolidation phase even as silver continues its climb. And some of my key multi-year upside range targets in silver have been up around the $63 level, whereas gold is still trading below the peak it set in late October, around 44.30 in the February futures that I'm monitoring right now. Its initial sell-off was what is likely the A wave of an ABC correction, and now this more drawn-out rally that has not seen gold really be able to muster any new acceleration to the upside. That's an elongated B wave, and I think with yesterday's interest rate drop from the Fed, that could certainly give a little bit of support for gold, since lower interest rates tend to help gold and the threat of higher interest rates tend to weigh on gold when there aren't other overriding factors. That we could see a little bit higher levels, but some of the indicators I'm watching in gold were telling me, and silver too, that they could set 2 to 4 week peaks right around December 12th or 15th, which basically is mid-month. So in the next couple of days, they could see a peak if they rally into that. So right now, I think that gold from a multi-month basis is still in consolidation. And if it doesn't close above 4,300 on the February futures, that would be another indication that this is just a B wave rally since late October, and that gold could then see a C wave decline into some cycles that are coming together in very late December and early January.
Silver hitting new all-time highs this week. What are you seeing ahead in the silver cycle?
Ever since early April, my work has kind of shown the same thing, that all of the white metals, they gave some very powerful, convincing buy signals while fulfilling multi-year cycle lows in early April. And I explained then, and I've continued to explain ever since then, that all of my cycle progression work and a lot of my technical work was showing that silver, platinum, and palladium should all move higher on balance. So, not straight up, but an uptrend into April, May of 2026. And that remains the case. And like I said, silver is now attacking some key upside range targets, and those are often just stepping stones, that there's a series of upside targets that, as timing permits and cycles corroborate, you see a market move up to the next level, then the next level. But for right now, I think that range around $63 is going to be key on a weekly close basis. So when we come into tomorrow's December 12th weekly close, that will be an indication whether silver, the March silver futures, is above or below $63. Should give some indication of what to expect in the weeks that follow.
Platinum and palladium are close to new highs. What's likely ahead for them?
Well, whereas I still have that outlook I mentioned for going into next year, that I think any significant highs in those other two white metals are likely to stretch into April, May. In fact, palladium actually has a few cycle progressions looking at the third quarter of next year for a final peak. Right now, however, they're trading a little bit more like gold in that they have consolidated since their October peaks, and I could see platinum retesting that October high, but palladium has been struggling to get out of its own way and has really just consolidated between about 14, maybe 1375 on the low end and 1550 on the high end. And that is also more indicative of a B wave bounce that could give way to a C wave sell-off before we see the next major uptrend into those 2026 cycles.
Light crude oil back under $60 this week. Where is light crude in its cycle?
Crude, I continue to watch some cycle progressions that are coming into play in late December, early January. I've explained why I thought that if crude was able to trend lower into that time frame, particularly if it stretched it into the first week or two of January, and if it could retest its April lows, that would be a much more convincing price and time conjunction for a significant low in crude. It has continued to trade lower on balance since its late June highs. It set a secondary high in late September, almost to the day 3 months after the initial peak. That's a very geometric 90 degrees on the calendar type of cycle, and that projected a subsequent decline into late December. So you've got a number of these timing indicators coming into play in late December and early January. And there's a couple indicators I'm watching that are also shaping up to hone exactly when and where a bottom is most likely. But right now we're still in the negative side of that trend and those cycles.
Natural gas hit new highs this month, not seen since 2022, then pulled back. Where's natural gas in its cycle?
I've described this in my Inside Track monthly newsletter for a few months now, but in my work, the August and October lows in natural gas fulfilled some very significant cycle lows, and from there, if natural gas was able to corroborate those cycles with some specific price action that I described, that it could move higher on balance into the latter part of the first quarter of 2026 into the March, maybe even April timeframe. But like I said, there are key price levels that need to be violated on the upside, some key indicators that need to be triggered whenever I'm looking at any convergence of cycle progressions and starting to get a higher confidence level in them. That's just the backdrop for me. I need to see specific price action and specific technical indicators validate those cycles, so it's not just a theoretical exercise. And natural gas has been going through this stage. I explained why I thought the first week of December should set an initial peak. It's been developing this 7-week cycle progression, and the time frame between December 1st and December 8th was the latest phase of that cycle progression and was expected to time a spike high. I thought it could get up close to 440. We spiked above 430 in the March futures, and it was at the extreme of that timing indicator. So everything came together to time a significant peak, and we've seen some selling develop since then. It could certainly go back and retest its lows, but I would not expect it to break below them by any significant amount. And then come the first quarter of next year, you get some other price time indicators. They're indicators that incorporate both price and timing. I guess they're a little bit like a moving average would be, but there's some other tools that I use that already are showing that's the time frame when you could see some more positive action in natural gas.
We keep hearing about food shortages. Are the agricultural cycles pointing to any shortages?
Well, I'm not sure which food shortages, but I certainly see some multi-year cycle lows and some multi-year support levels tested in your primary grains, soybeans, corn, wheat. And so I think that bottoms are definitely forming in those markets, but that doesn't mean you see an immediate uptrend from there. And really looking at soybeans, they fulfilled expectations for a significant bottom in August and a rally into late November, early December. They are undergoing an initial correction from there, and I have some pretty solid support levels between about 1075 and 1085 in the March soybean futures. As long as they can hold that level, I would see that as a secondary low and the time for a more significant uptrend to start to take hold. But even there, that doesn't mean you see an immediate surge from there. It just means you're going through that base building process, and that soybeans could be preparing to enter a third wave, a wave 3 advance in first quarter and second quarter of next year. But there are some very specific technicals I need to see kick in to tell me when we're likely to exit what's more of a consolidation, base forming phase and structure, and then enter a more trending and accelerated move to the upside. That's when I want to be devoting my resources to opportunities like that. Not when markets are just going to be frustrating you by going sideways, up, down, up, down, up, down. Not sure whether the breakout was valid or not. I want some of these trending and acceleration related indicators to kick in, and right now it's showing me that they're not likely until after a specific time in the first quarter of next year. But I do certainly see some bottoming in those markets, And on the flip side, you've got markets like coffee that are showing signs of a significant peak and starting to go through a topping process. You have markets like cattle and hogs that fulfilled some very convincing upside targets. They had some initial sharp sell-offs and are now starting to move back up. But the question there, and again, there's key technicals that answer this question, is whether that's the start of a new impulse wave higher, which I don't think is the case right now, or whether that's some sort of B wave rally where your initial decline is the A wave, you then get a rally that recoups at least 50%, sometimes 2/3 of the initial decline, and then you are set up for a C wave decline that ultimately takes out the initial lows and goes down to some more significant 6 to 12 month support levels. That's where some of those livestock markets appear to be at. The next couple of weeks should clarify that to me and tell me whether we're ready to set secondary highs and turn back down in those markets. So from the general term of food, that could apply to so many different markets that you need to kind of hone that to see which ones you're looking at and whether any shortages might be possible. I would say looking out into 2026, it's probably the grain markets that might start to enter that type of risk. And that also depends on whether it's more a demand-driven or a supply-driven move up, which some of you should get some indications of that too as the year starts to unfold.
Eric, you had a great call on the lithium ETF, LIT, last month. It topped after we talked, pulled back. This week it hit new highs. How's the lithium and battery stocks ETF looking from here?
Well, as I've continued to say, that index and related indexes and ETFs really trade more like a stock. And so the fact that the stock market was projected to rally from early April into late 2025, that's the same thing that the LIT ETF has done, even though lithium itself declined through a chunk of that time. But once lithium set its bottom and then it went through what could be kind of an ABC upside correction, that really helped spur some more gains in that LIT ETF and related stocks and whatnot. Lithium itself is showing that a peak could be forming. There are some weekly cycle progressions that it really adhered to. And what would surprise me is to see the ETF spike to new highs here in the second half of December, even as many broader stock market cycles are projecting a very significant peak. And at the same time, the lithium itself maybe peak out at a double top or even a slightly lower high than its November peak, and that kind of divergence is what you start to look for as indication of a topping formation. But just on the LIT ETF, I'm looking at next week, the time frame between December 15th and 19th, when several intermediate, both daily and weekly cycle progressions are coming into play and telling me it's a little higher likelihood for a peak at that time. So if the if yesterday's interest rate news and some other stock bullish factors can just spur a little bit more upside and maybe a spike to new highs, that would be a setup for a more significant top in that ETF.
Eric, where can our listeners subscribe to Inside Track, spelled with 2 I's?
They can go to our primary website at InsideTrackTrading.com, and as you just mentioned, the word inside has 2 I's in the center, so that is INSIIDE TrackTrading.com.
Eric, all the best of the season.
And to you as well, Jim. Thanks for having me back.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Coming up, Hilliard MacBeth, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Hilliard MacBeth, author of the second edition of the book, When the Bubble Bursts, Surviving the Canadian Real Estate Crash. His website, MacBeth.McLeodPartners.com. He's speaking to us from Edmonton. Welcome back to This Week in Money.
Nice to be on your show.
Where can people get your book?
I think at all the major bookstores, all the best bookstores, as they say, and of course on Amazon, Kindle, and all Kobo, and all those online offerings, ebook offerings. It seems like more copies are sold as an ebook now than in hard copy, but or in paperback, I should say. But it's timely. The book is timely now because of what's happening in the real estate market in Canada. It's a lot of what I talked about 7 years ago now is right on point with what's happening now.
This week, the Bank of Canada held the bank rate at 2.25%. The U.S. Federal Reserve lowered their rate by a quarter point. The Canadian dollar showed signs of strength this week. It looks like the Canuck buck might have put in a double bottom in November. Are you bullish on the loonie?
It's hard to be bullish on the loonie. The price of oil is quite weak. It has been for quite a while now. It's below $60. It's drifting down to 57, even though the U.S. is capturing an oil tanker off the shore of Venezuela, which normally in a bullish market would have probably pumped the price up a couple of dollars. So, and our exports of other commodities like fertilizer have been curtailed by the U.S. So Canada's in a tough spot, and with the slowdown in the real estate construction business, I expect there'll be a recession at some point fairly soon. Pretty much all activity in Toronto and Vancouver is halted, and that was the major. They're still finishing up the projects they started 2 or 3 years ago, but new projects there just aren't any, or any large amount of them. And the thing is that real estate, they call it investment in housing, was at one point 10% of GDP, and it's been averaging 8% of GDP for more than a decade now in Canada. So that's a huge. So a drop in that by 30% or 40% would take 2 or 3 points off of GDP, and the GDP doesn't have that much room to lose 2 or 3 points. So in a recession, the Canadian dollar presumably would go down below 70 cents, and of course unemployment would go up from the current 6-point-something% up to 9 or 10%, and we would see much better opportunities to buy Canadian assets, like as measured in Canadian dollars.
Is the Fed rate cut likely to cause more price inflation and a booming stock market in 2026?
Yeah, the quarter of a point by itself just cannot really do much. Right after they cut the rate on Wednesday, I was watching it closely, and the market rallied for a little while, but and then on Thursday, Oracle came in and had showed some bad numbers on their earnings report. So the market didn't sustain the rally, but a quarter of a point by itself. The bigger thing was the Fed went to a stance where they said, we're kind of at neutral now. And so if there's sign of higher inflation and a strong economy, we'll raise rates in 2026. And if there's a sign of a recession or lower inflation, we might cut rates more. But they're kind of the way he was talking, they're kind of done for now. It's going to go one way or the other. And my bet is on the recession side. One of the big things that people are holding out for the economy to keep going, because there's signs, mixed signs in the U.S. of some show strong economy, some like the labor market show a weak economy. But the building of these data centers and the electricity that's required to power them is a big part of the optimist view. And the reality is probably a lot of these data centers won't get built. The big reason why Oracle's numbers disappointed and the stock went down 14% or something, the biggest drop in 25 years, was that they're spending more and more money, but they're not getting the revenue from what the capital spending. So it's going to get tougher and tougher for companies like AI and some of these other ones to OpenAI, I should say, to raise the money to build these data centers. And then the other thing is permitting. It's not that easy to get permits to build these massive, gigawatt plus data centers. So that could slow the economy down too. And the U.S. Real estate market is not great either. So, but the big weakness showing up is in the labor market with job cuts. Job cuts basically right now in 2025 are higher than any other year except for the COVID year, when job cuts went off the charts up, and 2009 when we were in the middle of the global financial crisis. And the cuts this year are only slightly lower than 2009. So that's a sign of some pretty serious labor market weakness in the U.S.
What's happening in the bond markets where mortgages originate?
Well, so the interest rates in the bond markets have been creeping higher, even though the Fed is cutting. Interest rates in the the 10 years now in the U.S. is now over 4.1%. So, and the mortgages have kind of built off of that. And of course, in the U.S. mortgages, the standard mortgages is 30 years in the U.S. So rates are quite a bit higher than that. So, but it's the mortgage rates affect people spending, consumer spending in the U.S., especially because they can refinance, right? So if they initially take out a mortgage, a 30-year mortgage at 7%, and then they can refinance at 5%, they've got they can either take a bunch of money out, or they can borrow more for the same payment and spend more money. And that's been going on for probably 15 years when rates were low, but lately it hasn't been possible. So the housing market in the U.S. is quite troubled, and the refinancing window is closed unless rates fall further. So consumer spending's got to come from somewhere, and it's got to come from either great jobs with wage increases or an ability to borrow a lot more money. And there's a question mark over all of that.
Do commodities have a bull run towards the end of bull markets and stocks?
Yeah, well, the commodity market is fascinating because it's been dead for so long. It's like I started in the late 70s, and it was gold and oil, and it was like, I didn't even. Well, I knew there were other stocks, but there was so much fun. We were having so much fun in the mining stocks and the gold stocks and the oil stocks that we spent all of our time. Our clients wanted us to spend the time in those areas. And everybody knew somebody that had a hot tip on a commodity stock. But those are relatively small in relation to the overall market. So it's quite interesting now that there's renewed interest in things like copper. Copper just hit a multi-year high recently, 5 years. I remember $5 an ounce. I remember it being, a pound. I remember it being as low as $1 a pound. But copper, it's used a lot in electronics, and a lot. These data centers, they have a huge number of amount of copper in them. Electric cars have 3 or 4 times the amount of copper in them that a regular gasoline car has. So the future for those kind of commodities is pretty good. But the real big speculation now is in gold and silver, and I don't know. You can't really say it's not correlated much with the economy or with the regular stock market. And gold and silver speculation seems to kind of go on, have a life of its own. It was big in 1980, and now it's big again. The price, by the way, just adjusted for inflation, just recently surpassed the 1980 price, which the high was $850, but adjusted for inflation, it's just a little bit below today's price. So now we're into new territory, real dollars, and the cost of buying a house. If you examine the cost of buying a house in gold, actually houses are quite cheap. But if you examine it in terms of wages in both the U.S. and Canada, prices are really expensive. So if you could collect your wages maybe in gold, that would have been the thing to do. I don't know.
What's the latest on housing markets in major Canadian cities, including Edmonton and Calgary?
So we talked last time about the weakness in Toronto and Vancouver. And Toronto is the biggest weakness. On the every month we publish a chart. People are free to look at it. It comes out on X, and or they can contact us directly. And it shows that the peak was in 2020, late 2021, early 2022, depending on which city you're talking about. Toronto's come down by the most. We're sort of in the 20-25% range, depending on what segment of the market you look at. And Vancouver's very expensive, and it's come down less than that, but it's coming down. Calgary and Edmonton were quite cheap in relation to the rest of the country. And, of course, incomes in Alberta are higher. Household incomes in Alberta are higher than any other part of the country, partly because wages are higher in Alberta, but also partly because the average age of the population in Alberta is quite a bit lower than the Canadian average. And so you tend to have 2 incomes in each household. And so you don't have retirees as much, and you don't have people staying home from work as much in Alberta. People are both working, and then of course they borrow more money. So the good news is the Alberta housing market is the cost is lower than the national average. It's higher than the national average if you took out Toronto and Vancouver, but if you include Toronto and Vancouver, then Alberta's lower, and people have more money here to buy houses with. But the downside of that is they've been able to borrow a lot more money. So the debt level of the households in Alberta is much, much higher than the average across Canada, just because lenders are willing to give them more money because they can afford a higher monthly payment. And so the correction that is now starting in Alberta, for a long time, Toronto and Vancouver were correcting, but Calgary and Edmonton were not correcting. They were, edging up or staying level, but now they've started to come down. There's been some stories in Calgary, especially of some fairly big drops in house prices. So with that debt load that especially young Alberta families have, it tends to be a more volatile economy, whereas you get booms and busts. They talk about the Alberta boom and the bumper sticker, just give me one more boom and I promise I won't piss it away again. That's been around 4 or 5 times. And because when the boom ends and you get the bust part in Alberta, it's much, much worse bust than the rest of the country. But Alberta and Toronto and Vancouver aside, Quebec, which is always a much cheaper housing market than most other provinces, is just hitting new record highs now for its house prices. So it isn't all the national average is down because Toronto's dragging it down, mostly Toronto, but the individual provinces, Quebec, is actually edging up a little bit. So but from much lower levels than it's like comparing apples and oranges when you talk Toronto and Quebec.
With Toronto, I recall when you told me Toronto had more construction cranes than all of the U.S.
Yeah, any other. So that it's actually an amazing story, because for years Toronto was over 200 cranes, and almost all of them are residential because they haven't been building any new office buildings for quite a long time, probably 10 years at least. But so they're almost all residential cranes, and they're still over. I don't know if they're still over 200, but not that long ago, 6, 9, 12 months ago, I checked and it was still over 200 because those kind of projects take years to complete, and the crane stays up towards the end of the project. But and then second, interesting enough, was in Canada was Toronto at 35. So Calgary at 35. So Toronto over 200, Calgary 35. And then you go into the U.S. and New York would have like 14. Seattle would have like a few more, or 20 or something like that. It's just, there was just no comparison. They were. Now somebody objected to that analysis and said the company that does the crane survey doesn't necessarily go to all the cities in the U.S. So maybe there's but the overall theme of the argument is correct in that there was way more building activity in Toronto at 5 million people than there was in virtually every other city in the U.S. And of course that's going to come to a big stop here pretty soon. The other thing we haven't talked about yet is the mortgage renewal. So we talked a minute ago about 30-year mortgages. Well, the good thing about the U.S. housing market is they don't have to worry. If they buy their mortgage, if they get their mortgage, they buy their house, and the mortgage is 3.5%, 4%, maybe 5% because the rates are a little higher there because it's a 30-year mortgage. If rates go up to 7, 8%, they don't have to worry because they don't get stuck with a interest rate change every 3, 4, 5 years. In Canada, we've got that disadvantage that if you get a 1.5% interest rate, as people were getting back in, 2000 2019, 2020, 2021. Now, 5 years later, 2021, this 5 years is 2026. So next year, going to be the largest amount of mortgage renewals in Canada for recent history. Something like 30% of all the mortgages are going to renew, and 2025 was pretty big too, and then 2027 is less than 26, but it's still quite. So over those 3 years, it's going to be a lot of mortgage renewals, and the rates for most people are going to be up quite a bit. They're going to be up to whatever, I don't know what you can get now. It depends on whether you take a variable or a fixed rate or whatever, but you're probably looking at 4 or 5%, let's say. Back not that long ago, rates were down around 1.5%, 2.5%. So that's quite a big jump. Now, most families can handle it if there's no unemployment, right? If nobody gets laid off. But if, like we talked a minute ago about two people working in a household, it's quite common, especially among younger couples. If one of them gets laid off, then the whole mortgage thing doesn't work anymore, especially if they get renewed at a higher rate. So this is the problem that I was trying to talk about in my books was we're living on the edge of a precipice. All it takes is a higher interest rate and a recession, which it's been regular recessions every 4 or 5 years for the last 50 years. You get the combination of those two things, and an awful lot of people get into trouble quite quickly. roughly 12 million households in Canada. You could see easily 10-15% of them, say 1.2 million to say 2 million households in trouble. And then that's when you get the housing market really weak. Although, unlike the 1990s and the 1980s, these days the government's much more willing to step in and stop the downside a little bit for people. Although at some point there's not much they can do, short of actually going in and buying up houses, which I guess the government could do. At some point there's it's like a quarter point interest rate cut is not going to do it, right? Even a full 1 point interest rate cut is not going to do it if unemployment's up around 10%.
The Trump administration says the Monroe Doctrine is still in force. The USMCA trade agreement expires in 6 months. What could all this mean for Canada?
Well, it looks pretty. This is, your question about the Canadian dollar, 72 cents. I mean, it's pretty dire. I think I'm having trouble envisioning a scenario where Canada comes out of this without some pretty big difficulties. And maybe it's worth it. I mean, to maintain our independence from the U.S. I know there's a significant minority in Alberta that thinks the opposite of what I'm saying, but I think most Canadians want to be independent of the U.S. And today, by the way, is the anniversary of Statute of Westminster Day, 1931. Oh. And we were given our independence from Britain. And the situation is difficult because our biggest customer is the U.S. Like whether it be fertilizer or oil or whatever. Defense, we're totally integrated in. Huge number of Canadian jobs integrated in these fighter jets like F-18s, and now they want us to buy more F-35s, and the government's hesitating over that. But if we don't go ahead with it, we're going to be penalized, and the USMCA could the negotiations could be very. But they could completely fall apart if we don't go ahead with the rest of the F-35 purchases. It's a threat that's already been made. So we do have a few levers on the other side that we could pull. If Alberta sells 4.2 million barrels a day of oil to the U.S. and that's basically mostly all of the U.S. imports. It produces 13 to 14 million barrels a day. It consumes about 20. The gap is almost entirely made up by Alberta oil, but I mean they have other alternatives. If I think our oil is quite cheap because of the long-standing arrangements that are in place. But Venezuela, who's been selling almost zero oil to the U.S., if that starts up again, they could easily supply. They've got as much oil as Alberta does, and it's probably could be produced a lot cheaper than Alberta oil could. So we're vulnerable there. The one negotiation that's getting no attention right now that's going on, in addition to the USMCA, is the Columbia Water Treaty. And it expired actually, it's now more than a year ago. I think it was September of 2025 it expired. But there's a mechanism in there. You don't have to renew the agreement right away. You've got like 5 years or something to do it. And they have a committee that's been talking for a couple of years, but they haven't said much about how the talks are going. And it's different. First I think it was 50 years. So I think the first one was in the 1960s, and maybe it was 60 years. And the indigenous population had really no say at that time. Most of this water we're talking about all of it's in BC. So this time around, the negotiations probably include representatives of the First Nations. So it's going to be a lot tougher. But the northwestern U.S. really needs our water. There's no question about that. And so that's one lever we have to pull. But it's very tough. I mean, when you're much, much smaller than the person you're fighting with, you have to get really lucky to survive. There's nothing you can do. You can be really fast. You can have your 8th degree black belt in karate, but if the other person's twice as big as you are, you're probably going to lose. So that's the situation we're in. We got to hope that, what happened. Ronald Reagan and Brian Mulroney both had Irish heritage, and they sang "When Irish Eyes Are Smiling" together, a duet. And so we need something like that. Somebody needs to do to find a common denominator with Donald Trump. I don't know. That's going to be a tough job.
Consumer confidence numbers in the U.S. are at the lowest level since 1980. Could this be because the consumer is finally tapped out?
I think so. They talk about the savings rate in the U.S. I just saw the numbers, and they're basically zero savings, which basically means that's way down, right? And it's because really, they don't have any way to directly calculate savings. It's misleading because they don't go to everybody's bank account and say, how much have you saved this month? Because nobody saves any money anymore anyway, right? So most people have debt payments every month, and so what they're really saying is they've run into a wall in terms of their borrowing capacity. So they're unable to borrow anymore, and that means their spending has to come down. And so it's quite scary. I mean, I think most people, when the rates were so low, I think most people, as long as they cover the payments on their credit cards and all that, they didn't really think too much about how much money they were spending. They just carried on. A week in Cancun, let's go. We can afford it. Payments are only going to be $260 a month or whatever. Let's do it. But now they've hit the wall, and that means that they're getting a little worried. And they also now it's a little early yet because the unemployment rate's only gone from 3.4%, which is actually 2 years ago, believe it or not, up to 4.4%, I guess 4.5%. Normally, when the rate goes up, it bottoms and the unemployment rate starts to rise. It keeps rising further than that, and a recession soon follows. If not already, a recession often starts well before the unemployment rate peaks. But what happened this time was the U.S. government decided to run this massive $2 trillion deficit, which is unprecedented. The only time the deficit was anywhere near that large was in the Second World War. And the rest of the whole time, from 1945 till now, we've never had any kind of government spending boom like this. Now, most of that deficit has come from tax cuts that were made by Donald Trump in his first term. And big tax cuts on corporations and some tax cuts on and a lot of, most of the taxes are paid by the higher income people and the corporations. So when you cut taxes, the benefit largely goes to them. So the average person does not actually benefit much from tax cuts. It's quite intriguing to watch people with average incomes get all excited about tax cuts because it doesn't mean a whole lot to them when you look at their actual situation, but they like to see it. I guess maybe they think someday they're going to be in the higher income tax bracket, but at any rate, it doesn't put many dollars in their pockets. But what it does do, tax cuts, is it lowers government revenue and it makes it for a bigger deficit. So that money's been going into the higher income people's pockets, and maybe they're not spending it on making the economy great again. Maybe they're spending it on something else. So, or maybe they're just saving it. Maybe they're putting more into the stock market. I don't know what they're doing. It's hard to tell. So, but we do know the average person with the inflation that came starting in 2021, huge inflation. 10%. I think it hit 10%, and now it's down to 3%. But that 3% is on top of the 10% we had for a couple of years in a row there. So we're looking, people are spending 25% more than they were before. And in some places, some areas of their basket, it's even much larger than that. So it's not surprising that consumer confidence has gone way down. And the next thing would be if they start seeing people get laid off from work. There have been a huge number of layoffs, but the unemployment rate hasn't gone way up yet. So that would be the next thing when people start seeing unemployed people all around them. Because a really bad recession, the unemployment rate goes to 10%, peaks out around 10%. As I mentioned a minute ago, it's 4.4% in the U.S. right now. So 90% of the people still have their jobs. 90% of the workforce still has their job at 10% unemployment. So that's not a problem, but it is a problem because when the 90% see that the other people are losing their jobs, they start to change their behavior. They get more cautious. They start saving more. So they start paying down debt instead of maybe they cancel that trip to Cancun and they just decide, hey, you know what, maybe we'll pay off some of our debt. So that's something we haven't seen for a long, long time. I thought we were going to see it in 2020. We didn't really see it. We didn't even really see it in 2009, believe it or not. It was like it was only a brief pause there, but so we have to go back quite a long way we have to go back to the 1990s to find a period when people chose to pay down their debt ahead of spending more money. But maybe that's what that consumer confidence number shows, that people have decided to become much more cautious.
Due to land grabs in BC by First Nations and concerns over title risk, could British Columbia's real estate markets, both residential and commercial, be in jeopardy?
Well, it is an uncertainty. I remember when I was researching the first edition of the book, so that would be 2014, 2015. I was looking at land prices and land costs and that sort of thing. And I found this website that had all the countries in the world ranked by their the security of private ownership of land. And I was shocked to see that Canada ranked very low on that, because actually all of the land in Canada is held in the name of the British Crown. And we're kind of like we're all renting the land that we think we own, right? Now, I'm oversimplifying, and I'm sure somebody knows more about it than I do. But when you look at the website, that's what it said. It said Canada ranked low on this security of private ownership of land, because the title talks about the British Crown. And presumably at the pleasure of the British Crown or the government of the day, they might have the right to step in certain circumstances and reduce your privileges of your ownership of that land. And now we're adding in another layer of uncertainty with the Indigenous claims. So it makes you wonder about the value of land in Canada. The other thing that I found in my research was, why is land so much more expensive in Canada than it is anywhere else practically in the world? There's only a couple other places in the whole world where land is more expensive, and it's hard to understand, because Canada's only got 40 million people, but it's got the second biggest land area in the world. So we got lots of land, but somehow we've convinced ourselves that this land is very valuable, and then it turns out that there might be some other claims against ownership of this land. So it's now in the short run, I think it's not going to be as big of a problem as it seems like right now. But the weakness in real estate pricing was already happening, and then this just throws a little more fuel on the fire to get people worried about it. The overbuilding in Vancouver and places like Kelowna, probably Calgary as well, Toronto, of course, huge overbuilding there, was going to push prices down when that bubble burst anyway. And then on top of that, if people start worrying about, well, do I actually own the land that I've speculated in? And it's, you go to Palm Springs, for example, Palm Desert in California, and you drive, and there's quite a bit of Indigenous land ownership there. And you'll notice that they don't have housing on there. They've got things like car dealerships and stuff like that, which, they've got some kind of a 20-year lease from the landowners. But people don't build houses on there. So maybe they have trailer parks on there, but they don't have individual family ownership. So it does exist in other jurisdictions, and it is another worry on top of all the other worries. But the big one is the debt. The ownership of property in Canada, because the prices are so high, it comes with a large amount of debt. And if you can't service that debt, then you have to sell. And that's the point we're at right now, is people are selling because they can't service the debt anymore.
October 2026 is the time frame for Alberta to vote on independence. Do you think Alberta is likely to remain as part of Canada, become independent, or join the U.S.?
Lougheed was a premier in early 1980, and we had the Western Canada concept. I don't know if you remember that. And I vaguely remembered it. But when this independence thing started up again, I looked it up, and there was an election. I think it was probably in 1982 or something like that. Lougheed was running for re-election, and he had a huge majority and all that. But these separatists were actually getting a lot of attention. And there was only one representative that got elected. I looked up what I think this is kind of funny. The two issues at the top of mind for separatism, independence were bilingualism and the metric system. we had bilingualism and the metric system jammed down our throats. But when you think about that, the place that doesn't have bilingualism and doesn't have the metric system is the U.S. of A. And so, to get back to your question, there seems to be a number of people that believe that Alberta would be better off out of Canada, and a lot of those same people believe that we could join the U.S. and be better off as part of the U.S. So, if by some, I don't see the numbers. I see that it would be a very big, strong vote for staying in Canada if the referendum were held now. But who knows? You don't know. It's a whole year away, almost. It's almost a year away if it happens, and who knows what happens? But if somehow they did vote for independence, I think Alberta would join the U.S. within a very short period of time. It would be a change, because Alberta on its own wouldn't last too long. Alberta doesn't have access to tidewater. It's got to negotiate pipe. I mean, imagine you can't get a pipeline. The Northern Gateway pipeline can't get the pipeline to the West Coast now when you're part of the same country. Imagine how the people that don't live in Alberta will feel about granting permission to build a pipeline through property in their province when Alberta is a separate country. There's no way you're going to get permission. So they would have to turn to probably the U.S. to find some friends. I sure hope it doesn't happen. And the way it looks right now, it doesn't look like they've got the support for it. There's a guy named Thomas Lukasik that has got enough. He did the petition, and he's got the question, very clear question. Do you want to stay in Canada? And you want Alberta to stay as part of Canada? I think that's something like that. And he may run that referendum before the government runs its referendum with its very kind of ambiguous wording, which is something like, do you want Alberta to be a separate nation, sovereign nation within Canada or something? That doesn't make any sense. But the Quebec referendum had weird language like that too. The referendum wasn't to separate from Canada; it was to have the permission to start negotiations to separate from Canada or something like that. But I don't think the people in Alberta are keen on that, but I don't know for sure.
The Republicans could lose control of the House in November or gain more control. There could be another Trump impeachment. There could be a former president tried for serious crimes. Would the stock market likely react severely to any of these actions?
The stock market, Trump was impeached twice in his first term, and the stock market doesn't seem to care. So really, I think one of the things that this whole thing has proven with Trump and Biden and Trump again is that the stock market doesn't really care about who's in the White House. Now, they do care about tax cuts, and they got their tax cuts in the first term. And when Biden got in, he didn't reverse the tax cuts. So he was running on the platform to reverse not entirely the tax cuts, but a portion of the tax cuts, about half of the tax cut. And he came very close to winning, but he didn't win. So at any rate, apart from that, I don't know that the stock market actually cares that much about it. A lot of the people in big business in the U.S. now, the very large corporations, some people call them the oligarchs. They don't really see government as a big problem. They see it as a small problem. I think this is my view in it, that they have to hire lobbyists and they have to donate money in the right place to get their way. But in the end, they usually get their way. So I don't think they would worry that much about what happens. But getting back to the premise of the question about, it does look like, first of all, most midterm elections, because of course Trump's not on the ballot, they go against the incumbent party, and I think the Republicans in the House, especially, have looked pretty. They haven't looked great in this period. They're really waffled on the Epstein files, and a lot of the MAGA supporters really feel strongly about the Epstein files being released, and the Republicans in the House have done everything they can to avoid having them released, and so they've lost a lot of ground with those people. So I think they're at risk of losing quite a few seats. They've only got a very small majority. I think it's only 4. It changes all the time because of special elections and stuff, but I think it's like 4 seats or something like that. So there would most likely be after November of 2026 that the Democrats will have the control of the House, but the Senate is probably likely to, a little bit more difficult to get control because only a third of the senators are up for re-election every 2 years. So it would take a huge swing to change that. And then even if you impeach the president, or you can impeach Supreme Court justices and other people too. I don't know if you can impeach secretaries of war. Maybe, I don't know. Anyway, so the threshold is really high. It's like 60% of the, or 66 2/3 of the percent of the senators have to vote to convict. So the House impeaches, which basically means they're going to prosecute an impeachment trial, which is held by the Senate, and then the Senate decides. So 2 times Trump was tried in the Senate, and 2 times they didn't have the votes. They voted pretty much along party lines. Maybe one Republican went in favor of convicting Trump, and then they didn't run in the next election. I forget how it all worked, but very, very few of them would vote in favor of, unless something happens in the next 11 months that changes their view. So for that reason, getting back to your question, I don't think the Democrats would risk another impeachment unless there was some really strong reason why they thought they could win the vote in the Senate and the trial that comes up in the Senate after the impeachment, because that would be the 3rd time they've lost. It doesn't look good for them. Yeah, I think the House will go to the Democrats in 2026, late 2026, but I don't think it'll make much difference.
Are you seeing more and more electric vehicles in Edmonton?
There's a lot of Teslas. It's like, but I wouldn't say there's a lot. There's a big surge. There's a thing that's happening now where people don't want to buy a Tesla because they're really upset with Elon Musk, and maybe not so much in Alberta, but in Europe for sure. But the best electric cars now are not made by Tesla, and they're certainly not made by Ford or Chrysler or GM. They're made in China by companies like Huawei and Xiaomi and Leapmotor and NIO, and there's like 32 brands in China. And the cars are better and they're cheaper. So they are not in Edmonton, and they're not in Calgary, and they're not in Toronto. They're not at all in Canada because of the 100% tariff on Chinese cars. And the same in the U.S., but they're in Mexico. Mexico City is like every 3rd car, apparently. I haven't been there, but I was listening to a podcast recently, and they said you walk out on the street in Mexico City, and you'll see a whole bunch of electric cars, but you might not recognize the brands because they're from China. They're building factories in Europe. They're building factories in Brazil. BYD is the biggest company, but there's a bunch more companies that are doing it. They're talking about building a plant in Mexico, but that's sort of slowed down now because the main reason for building a plant in Mexico would be to export Chinese electric cars into the U.S., which this would be difficult right now. So we're not going to see a huge surge. So the numbers are, to give you an idea, 50% of all the cars sold in China are electric. 10% or less of all the cars sold in North America are electric. So there's and then the Europeans and the Brazilians and the other people are in between, 20, 30, 40%. Eventually everybody will be over 50%. China will be 100% soon, and eventually the U.S. will come up to those kind of numbers. But until that tariff gets removed, we're not going to be able to buy the Chinese-made electric cars in Canada. It's too bad because right now the options are limited, but it would be nice to have access to that. To China has proven to be the manufacturing king of the world, and the U.S. has lost that crown a long time ago. The gap is just getting wider. So it's I don't know how it's going to be resolved, but it's until we get that resolved, we probably won't see many huge numbers of electric cars in North America.
Hilliard, where can people follow you, and where can they buy your book?
So I put out a weekly note on Fridays. Usually I write it. Sometimes another Fraser Bekowski, who's on the team, writes it, and sometimes other guest writers write it, but usually I write it. But and you could get that by following me on X, and then there's a link to that, or you could sign up directly with our MacBeth McLeod Partners website. Easy to find, and I've also started to be a little bit active on some of the other ones because X is so dominated by Elon Musk and his band of I don't know what the word for it is, but anyway, it gets kind of tiring after a while. So, but I haven't really found the place to go yet. Blue Sky is a possibility. A lot of people are going to Substack, but that generally is not short messages, which is the nice thing about Twitter is you can get really short messages on there, and Substack is longer pieces of written material. So that's where it is. And if you want to get a message to me, just go to MacBeth McLeod Partners and email me there, and I might even reply.
Hilliard, thank you so much for being on This Week in Money, and best of the season.
Best of the season to you, Jim, and to all your listeners. Thank you.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for any of our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.